Welcome back to America's Commercial Real Estate Show. I'm Michael Bull. This segment is brought to you by Xceligent, building data everywhere. Visit xceligent.com. And we're talking about Viewpoint, the 2017 real estate forecast report put out by Integra. And we have the chairman here, Anthony Graziano, and we have Mr. Hugh Kelly, principal with Hugh Kelly Real Estate. And gentlemen, I think one of the things that really does impact commercial real estate world in a big way is the debt, the mortgages, the financing, the capital stack. We have some discussions about deregulation to maybe make it easier for us to get funding. And it seemed like in the fourth quarter, financing became a little bit tougher because of some of these regulations. What do you expect moving forward?
Sure. A couple of different things. I think, it's going to take a long time to change Dodd-Frank. I mean, the concept that we're just going to unravel that regulatory control in a very short period of time is probably not realistic.
We can't just tweet it out.
No, I don't think we're going to tweet it out and just change it on the fly. But, the other thing is that when you look at how much lending is being done by which institutions, the apartment market has been primarily supported by, HUD and GSA-backed money. But the balance is really the balance of the lending in the market over the last 3 to 4 years has been the big banks. So those that they get hit up and bump up against capital requirements, which then pushes opportunities down to the mid-size and smaller commercial banks. But those are sort of they're in a less position to watch their risk, and those are the ones that we really have to keep an eye on risk. I think in terms of availability of capital, we spend the rest of the year with plenty of capital available at, again, historically low interest rates. The difficulty is, we're going to have to watch appraisals and make sure that the appraisals are being done with good care and due diligence. And we should be scrutinizing more the forecast of values based on new construction and based on other risks that may be present in some of the markets. So it's going to be really important, I think, this year to be properly measuring risk. And that's going to be what's hard at the micro level, but when you get up into the macro level of the banks, risk measurement is going to be very, very important. The CMBS market has not really come back in force. The regulations on counterparty risk there really continue to hold back the volume of the CMBS market. But I think, they're back to a certain extent playing a big role in large scale project development. But the CMBS market, I think, is still nascent from what it historically has been.
Yeah, and there are other players as well. Of course, you've got the big life companies, which have the ability, because they've got, much more, many more borrowers, potential borrowers, than they have money to lend. So they can be very, very careful about their underwriting standards and have been. You have, foreign capital and foreign debt capital that's in their private debt funds that are there. And on the bank side, I watch very, very carefully the Fed's quarterly senior lender survey, and I'm starting to see now it's off a period of extreme caution, but a little bit loosening in underwriting standards, a little bit more willingness for the banks, particularly in the regional and community bank space, to work with borrowers to do deals, and that's fine as long as the market is rising, but that's where risk comes back to bite you once the market turns down.
Yeah, I hope that we can maintain discipline. I think that the discipline against the banking lobby is going to be this is going to be an important turning point over the next 12 to 18 months to continue to make sure that we exercise discipline in the banking system. And the tendency is, you want to get more money out the door. That's how the banks are going to be making money. As interest rates rise, it's going to be harder to run a profitable bank. So you're going to attempt to want to compensate by increasing your lending and being able to change those ratios. So the banks are going to ask for different capital ratio calculations. They're going to ask for reductions in Tier 1 capital and the balance of what they can lend versus what they have in deposits. And I'm hopeful that the market demonstrates discipline and then that we demand discipline of our banks.
And the Board of Governors at the Fed.
Yes. Who are already signaling that there may be issues of over lending and overheating in the lending.
Yes. So there are a lot of players in this space. Right now, we're in a good spot. The commercial real estate market is healthy. Values, I think, are not overblown. The market, in terms of transaction volume, has pulled back, signaling that the capital is not just willy-nilly chasing deals. I think these are all good signs. For the year ahead, I think we can maintain that. My issue is what happens when we run out of economic momentum.
Is this an environment, gentlemen, where private equity gets more involved in mortgages, crowdfunding, and other investors that look at the safety of providing the debt for these properties so they're not at the top of the capital stack as an investor?
Sure. Yeah, I'm not a big crowdfunding proponent. To me, in a time when you have abundant capital that can be funded through traditional sources, what's left for the crowdfunders is the leftovers. And so you have the least sophisticated investors investing in the riskiest of prospects. That is going to be a very, very dangerous situation. And I really believe that, again, when the cycle inevitably turns, it's those guys that are going to be hauled before Congress to explain why they put money into projects where no reputable lender would.
Wow, there's 5 crowdfunding companies that have just called for you to be on their board. I just hear them ringing you now.
Let me say this though. We are starting to see in the private capital, certainly in the home office money, in South Florida and generally throughout the United States, the home office money is migrating into mezzanine debt right now. They see an opportunity on the mezzanine side to convert. They were traditionally acting as equity, the home office, private equity from foreign capital and domestic. They're now shifting to mezzanine. And to me, that signals, number one, a reduction in the loan-to-value ratios from conventional sources, so mezzanine is required. But even their injection into the stack is basically a signal that there's a spread that has to be filled, number one, and number two, that there's a debt play there. There's an opportunity to be in the debt position to possibly control the assets into the future. So
yeah. It's an interesting thing because there are different ways of playing in the middle of the capital stack there. And from the point of view of senior lenders, you would rather see not mezz debt in there, you would rather see preferred equity in there.
Right.
And actually, from the point of view of an investor, you'd rather have the guarantees that come with a preferred equity position than the secondary debt position, I would think.
Yeah, well, there's some good opportunities. And you mentioned that you want to be careful forecasting values. And so my question for you is, if you're forecasting value and you're looking at a 5-year hold today of an acquisition, and I know you don't have a crystal ball, but
I do have a crystal ball.
You do have a crystal ball.
Ball.
Okay, you're a commercial real estate expert. So what are you putting in for an exit cap rate 5 years from now? If you're going in cap rate at 6%, let's say, for an example, and you're going to have interest rate increases. Now, hopefully, you've got, and I guess we know we'll have some income increases, right, in the property that may offset the downturn. But what are you using for exit cap rates 5 years from now?
Sure, that's a great question. It's a little bit technical, but I'll give you a couple of thoughts on that. One of the difficulties is I can forecast and look and see where the market's coming in terms of new supply. The important thing is to correlate that to what just happened over the last 3 or 4 years. And I think what happens generally in the appraisal business is that the pressure from the lenders and the borrowers and all the people that have an input during the appraisal process, they want to look at what happened yesterday when it's convenient to them. So the rent has been growing 4, 5, 6% over the last 3 or 4 years. They want you to say, well, rent's growing faster than 3%, so we want the forward projections to look like what's been happening.
That's what the broker said.
That's what the broker told me. That's how we bought it. That's the pro forma we bought it on.
Yeah.
We think the spread on the exit capitalization rate is too high. You're using 75 basis point spread, and we only pro forma a 25 basis point spread. And you say, well, okay, but what is 10 years? Let's go forward 10 years, and let's think about the building being 10 years older. It's going to need capital and so forth. What we're seeing in the market, though, is that the institutional market is being fairly aggressive still on exit capitalization rates, maybe a 25 to 50 basis point spread over right now what we know are historically low cap rates.
Wow.
They're still building that into their pro forma on the exit. 50% generally of the net present value is in that reversionary calculation. So if you are too conservative on that, you could be overpaying for an asset today. My bigger concern, though, is in the cash flow, is when you start growing cash flow, near-term cash flow, and compounding that at 3.5%, 4% plus. That ultimately leads to a higher NOI estimate at reversion that you're then capitalizing at too low of a number.
And the other factor in that, right, is as you're discounting that, what's your discount rate?
Right.
So if you are aggressive on all of those other assumptions, but you manage that enthusiasm,
right, with a measured idea of your rate of return and discount rate.
That's, then I think you're okay. But if you have spectacularly optimistic assumptions, and then you take a discount rate and apply, treasuries plus 100 basis points, you're dead. You're going to be losing money.
So I'm a broker. So what do you tell me that I should say to an investor who's doing, if you're hearing some institutional investors using a 50 basis point increase in cap rate for 5 years from now, when I tell my investor that and he says, Michael, no way. Interest rates might be at least 2-3% higher possibly. What do you mean a 50 basis point increase in cap rate?
Are you saying it should be higher?
I would think so.
Yeah, you would.
Yeah.
You would. But the market's not pricing it that way, I can tell you that right now. And that's obviously
But
part of
no
the
one has a
long-term.
gun to your head saying you have to do that deal.
Yeah.
No, that's true.
That-
But if you're in the market to buy and you're not buying because everybody, if you continue to lose deal after deal, you're eventually going to follow the herd. You're going to lower those numbers.
But that goes back to the collapse of the bubble, right? Mm-hmm. As long as the music's playing, I have to stay in the dance.
Right.
No, you don't. The smart money, Zell, let's take equity office, got out before the music stopped.
Yeah.
And that was the smartest move in the last cycle.
Yeah, so it goes back to my earlier question, is it time to buy or time to sell? Well, gentlemen, if you will, leave us a parting tip for our viewers and our listeners looking forward to 17 and 18 that you could give them.
I'm going to go back to your Gretzky quote, look at where the puck's going. Mm-hmm. Be where the puck's going to be. Don't be where it is today. I think that if you look ultimately at the markets that have strong employment growth, the states that have strong population growth, we identified in our publication, Florida, Seattle, Oregon, Colorado, these markets have very strong population growth. That's going to be the area where real estate will perform. And I think, as Hugh mentioned before, you look at where the strong economic opportunities are in terms of job growth, and you focus on those markets as core. And understand that the Tier 1 markets now have been on a bit of a bull run for the last 4 or 5 years, so get very serious about your exit cap rate strategies in Tier 1 markets. I think there's still a lot of opportunity, though, in the Tier 2 markets.
Good tip.
Yeah. Don't extrapolate. This industry does not move in straight lines, and you have to be ready for change. Because if you're not ready for change, you're going to be begging for change.
There's only one constant in this world, that's change, right?
That's right.
Well, gentlemen, thanks for joining us. We appreciate your insight. Great report.
Thank you, Michael. Appreciate the time.
Michael.
Yeah, and we'll have a link to the report on our website at commercialrealestateshow.com. And when you get there, just look for the Viewpoint show. We'll have the link right there. And thanks for joining us on the radio stations, on iTunes, on Podomatic, on YouTube, on the show website. We really appreciate you being with us. Until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. Hey there, thanks for checking out the Commercial Real Estate Show. Don't miss a video of special interest to you. Be sure to subscribe below. And if you appreciate the videos, be sure and thank our sponsors. There's a link to more information about them in the description. For more videos, podcasts, and articles, check out CREshow.com.